Felix here. We've been thinking, Tallulah and me, that there must be a way we can make money out of this slip in the stock market. There must be an opportunity in there. What is it? Let's dig deep. So we've done that, and we've come up with our top 5 stocks that are not only down, but are also brilliant businesses, well executed, and potentially have really, really nice upside. And now might be a time to look at it. What do you think, Tallulah? I think she's with me on this. So, of course, not financial advice. It was literally picked by a cat. And let's jump straight into it. This is the performance of these 5 stocks. Tallulah knows this off by heart, so she's looking the other way, watching out for all the stuff back behind me. And I'm not going to give away all the names at the beginning because that would be really boring. Where would be the fun in that? No, let's go through them. Let's look at their fundamentals, their performance, the margins, how good the business model is, the management, and why now might be a great time to look at these. So don't blindly buy them, but do some research. Second, performance. We're actually up 112% so far this year. That's return on capital employed. And that might seem really baffling and bizarre to you. If you want to make that less baffling and bizarre, then come and join us. Literally, in my view, a 12-year-old can do this. I don't think this is rocket science. Not promising you returns, but promising you to give you the entire strategy for free, a workbook, walk you through it, do some live trades together, answer all your questions. Is that a deal? It's free. FelixRents.org/webinar. Sign up, grab one of the spots available there, and Tallulah is off to prepare the presentation. And now she's sitting on the mouse pad. Oh, all right. So let's look at some fundamentals here. And I also want you to walk away with the ability to, seriously, cat on the mouse pad doesn't really work very well, with the ability to do this analysis yourself, come up with your own decisions, which is why I walk you through not just a top list, but actually explain how we get there. So one of the key numbers I look at is gross profit margin. And the reason for that is if you have a really high gross profit margin, it means there isn't a competitor out there who's doing the same thing much cheaper. And that usually means it's hard to replace you. You've got loyal customers. You've got a product with a big moat. I usually look for numbers 60% plus. There's some industries that are a little bit lower. Some industries are a little bit higher. That's pretty good though. Second thing I look at is return on invested capital, often abbreviated as ROIC. And that basically tells you if I give the company $100, how much do they turn that into in 1 year, right? So 17% more money, that's $17. This one, 41% more money. I give them $100 in a year's time, they've turned that into $141. That's pretty staggering stuff. Now this one's negative, we'll explain why in a second. I also look at long-term profits growth. Why? Because I'm not that interested in the quarter. I'm more interested in the last 5 years or so. So again, you want solid numbers. Generally, I want them to be 12% plus because I want my portfolio to grow 12% plus. Free cash flow, I'm a huge fan. Love the stuff. A lot of companies grow, but they never actually have any free cash flow, which means there's never any money in the bank, which means they keep having to keep running back to Wall Street, dilute the heck out of us or take on bonds and so on. And then I look for relatively low leverage. Now, there are, again, some industries where leverage can be higher. It might make sense. But generally, you see most of these have sort of a 2-point-something X leverage. That's a pretty decent number. Now, some of these stocks might be familiar to you. Some of these will not be familiar to you, but I'm going to walk you through it. And I will tell you what they are. Don't worry. It's not going to be a complete blind thing, but just a bit of fun in this, okay? Profit health is the most glorious thing out there. And A is like the super score, super nerd, brilliant. Growth health, also very important. Cash flow health here is so. Relative value, I don't really care that much if you have a long enough time horizon, but I think actually this, by the way, can go to E and it can go to F. So D is not too bad. It's kind of okay. And generally, an A in profit health means a relatively poor relative value, just because great stocks ain't cheap. Okay, so what's stock number 1? Well, let's get the eraser out here. Eraser. And there we go. Can you see that? It's LVMH. F. Doesn't matter. There's also Y. They're OTCs. They're over the counter. They're listed in the US. So they're down 3.5% percentage points this month. And you might be thinking, well, that's not a lot, is it? It's not exactly the greatest dip buying opportunity. Well, bear with me and I'll show you just how much of a dip buying opportunity this potentially is. So gross profit margin for LVMH is off the rocker because there are lots of women who walk around and go, you know what would complete me? A handbag. No, not the 98 in my wardrobe, but this one that's $5,000 and owned by LVMH. And I know I'm picking on women. They also sell a lot of stuff to guys. I mean, the booze segment, and obviously, men spend money on all sorts of stuff. So that's what it's all about. Revenue 92 billion, 18 billion profit, 17% ROIC, long-term profit growth is 15% a year. That's just so staggeringly insane. Your profits go up every year by 15% because your clients are basically indoctrinated, addicted, brainwashed, that they think they don't exist without your label. It's amazing. It has a perfect Piotrowski score. Piotrowski wasn't actually Russian. I think he was American. And he came up with this sort of, he's like the guru, the sort of Buddha of the value investors. So if you talk to a value stock hunter and you mention Piotrowski, they'll start drooling a little bit and get all excited and shaky and take their clothes off, that sort of thing. So just implies that the stock is very, very fairly valued, and it's a great deal. Of course, it's just an indicator. Our indicator is perfect. Consistently increasing profits per share, and per share is important, no dilution. Raised dividends for 3 consecutive quarters. I'm not a fan of dividends, but there's worse things people can do. Impressive gross margin, oversold, as we're talking about here, and high return over the last decade. Okay, so let's look at some of this. Earnings. We haven't got earnings per share numbers because it's a European company, but they're beating revenue by staggering amounts every single quarter. 20 million off 23 billion is basically irrelevant. I mean, somebody bought some extra stamps or I don't know, another helicopter for Monsieur Arnaud, and this is what they own. And it's just everything. I mean, basically, you can't really go through the nicest part of town in any country in the world without dropping some money at these places, if you like nice places. So, you'll be familiar with some of the booze brands, obviously LVMH, Dior, Celine, Kenzo, Givenchy, Marc Jacobs, Loro Piana, Berluti, Medio Pucci, all that sort of good stuff. And if you're eating out, Cova, Galleria, Sephora, if you're shopping, De Beers, for diamonds and bling, and Acqua di Parma, and just everything, really. They just own the luxury space. Nothing you can really say about that. Results for the year, absolutely staggering. You think the consumer is tightening their belts? Well, this lot isn't, because this lot spent 17% more. Free cash flow was 1.8 billion for the first half of the year. Organic growth was 17%. Just insane. For a company that old. And where are they making money? People are drinking a little bit less, which is kind of interesting. But, fashion is up 17%, retail up 26%, perfume, watches. It's just a growth machine. And they're growing everywhere except the US. But the US, it doesn't matter to them. You see, they just make more money in Japan or in Asia or in Europe. They're that well set up, and they did incredibly well during the pandemic. And this, I want to show you this. So what have I got on this chart? Down here, I've got earnings per share. And you can just make it out that where we're trading right now is here. So we last were there in 2022. And earnings per share have increased substantially since, from 23 euros to 31 euros. That's $8 more. That's more than 20% more. So the fundamentals are 20% better, and the stock is cheaper. The stock is flirting with, this is a week's chart. This stock is flirting with the 150-week moving average. And we only touched that. This was COVID. That's the only time we've actually touched that. And then in sort of late 2020, when everyone's screaming recession, we were close to that. We're once again close to it. So it's a fairly rare setup. and it's just staggeringly profitable. And the COVID response was this. It really wasn't a lot. I mean, you can barely make that out. Yep, they dropped from about 450 to about 300, and then boom, straight up, because everybody realized that the wealthy still shop. They don't care. They've got money. Doesn't matter. They've done really well through COVID. So if you think a recession is coming, this is actually a recession-proof stock in my view. Okay, stock numero dos. Financial health is profit health. A, growth health. B, cash flow health. B, and relative value at D is not bad because there's still E and F, as I mentioned. So actually quite happy with that. Now, what is this stock? This is one you might be a little bit more familiar with. Let's do the grand unveiling. Tallulah, could you do something about something grand? Grand gesture? I'm sleeping on my lap, making me really, really hot. Well, maybe you're not that familiar with it. It's called IDXX. What's it all about? It's about... We've got a visual aid. We've got a visual aid. It's about these guys. This one here. And what do they do for those guys? Well, unfortunately, it's injectables and things like that. So we don't like to go to the vet. We never really go to the vet. We just try to keep kittens and creatures around here healthy. But look at the numbers. Gross profit margin, 68%. Is that right? No, that looks like the LVMH slide, doesn't it? That's not the right slide. Let's look at these numbers. Yeah. 10,000 employees, 175 countries, serving 2.5 billion people, over 80 reference labs, and they support 50,000 vets around the world, and that's their customer. The drinking water thing is almost irrelevant in terms of revenue. They brought in Q2 almost $1 billion revenue. That was 10% up, organic growth. And it's basically all about pets. That's 867 million of their revenue. The water thing is like it's a little fancy add-on, and then livestock is 830 million. But that's what it's all about. So they basically make their money with veterinary consumables. So every kind of test you do in a vet pretty much comes from IDEXX, and there are one-time use consumables, so they have to throw them away. And then there are laboratory results attached to that. That's another 330 million. Diagnostic service, that's another 10% on top of that. And the diagnostic instruments is another 10%. So you buy the instrument, you buy the consumables, you use it every day, you send money to IDEXX shareholders day after day. Nothing you can do about it if you're a vet. Now, we've had less vet visits. Might be a COVID hangover. There are more pets out there than ever. But they brought in more revenue. So you've got falling visits, but you've got total revenue up 8.5%. So that's kind of crazy. So they obviously have pricing power. No one's switching away from their stuff. And here is actually the real data. So 60% gross profit margin, 3.5 billion revenue over the year. 790 million of that is profit, which is very, very impressive. 41% return on invested capital. You try doing that at home. I mean, try buying a property and making a 41% return the next year. That's almost impossible. Right? So really, really, really good business. Super consistent on earnings per share growth. Pretty much always beat, except for one quarter in 2022. Revenue always beats. They also get cat fur out of your nose, apparently. Special roller for that. No, but that will be a great product for me. Look at their stock chart. So what have we got here? We've got down here again, earnings per share. And earnings per share right now is higher than it's ever been. Yet the stock is valued at 2020 levels. When earnings per share were 670, now they're 940. That's like 25% higher. How does that make any sense? Well, it's market sentiment, isn't it? We're trading literally below the 200-week moving average. The only time we've ever done that was down here, beginning of 2022. We did it during COVID and briefly in 2018 stock market crash. You see what I'm talking about? It's a little bit cheaper than Nvidia, isn't it? Maybe not as sexy, but great business in my view. Of course, always come to your own conclusion and all of that. Next stock numero tres. Profit health is A. You see, I promised I'd deliver you the goods. Growth health, 5B. Cash flow, B. That's pretty good. Relative value, D. Well, we're quite happy with that, right? We're getting used to the Ds there on that score. Consistently increasing earnings per share. I love that. Oversold. Low PE relative to near-term earnings growth. Trades with low price volatility and profitable. Modest debt. Doesn't pay dividends. I actually really like that. Take the money, reinvest the bloody stuff. You're surely going to make more for money for us than if you just hand it out, right? So what's the stock? Well, let's get our little eraser. No, it's not LVMH. No, it's not IDEX. It is AMADY. And you're like, what? What? What is that? Search it. Google it. Somebody. The cat must know. Amadeus. Have you heard that irritating German song? It was German, wasn't it? I'm German. I apologize profusely for that. Yeah, that's the thing we Germans are ashamed of. Nothing else in the history. Oh, dear. That's a topic we opened there, isn't it? So gross profit margin. That was a joke, by the way, in case you had a complete sense of humor bypass. And, like if you were German, for example, in which case that would be excusable, I would imagine. Gross profit margin, 43%. Pretty good. Revenue, 5 billion. Profit, almost $1 billion. Return on invested capital, 10%. Sort of borderline, isn't it? Long-term earnings growth rate, 23%. Okay, now we're talking. Now, what's going on here? What's going on there? What's with those charts? What the heck happened to this business? And what do they do, for crying out loud? Tell me. Amadeus distribution market share worldwide from 2010 to 2019. They have a 44% market share of something. Now, what's that something? Well, let me show you. Bookings, fancy. Bookings went up 17%, but still 23% lower than 2019. What is it? Flight bookings. They have a 44% global market share of flight bookings. You don't think that's exciting? I think that's incredibly exciting. Every time you click on book a flight on any website pretty much in the world or through your airline or anything, Amadeus collects just a little bit of Mozart gold juice and hand it over to shareholders. Now, they've had a tough time because of COVID, and the whole flying around thing hasn't really come back quite to the same extent. Zoom is to blame for that, and Teams and all of these blasted apps. Now, but look at their first half of the year highlights, earnings. 28% more revenue, 41% more earnings before, interest, tax, and so on. Higher margin. Profit is up 85%. Free cash flow up 57%. And leverage is pretty low. They pay a dividend, a share repurchase program for you people who love that sort of thing. And they don't just do bookings. So they have IT solutions basically for airlines, pretty much every airline out there, but also airports. So for example, the JFK Terminal 4 operator, they use Amadeus Auto Backdrop in the kiosk self-service technology. Those bloody things where you have to check in yourself. That's all Amadeus. I know it's terrible. We hate the stuff, but it's there. We got to use it. And they work with everybody. Etihad, Hawaiian Airlines, Air India, Air Canada, like everybody. Literally, absolutely everybody. And what you can see is that they're still below 2019 bookings. So they're giving us the pre-COVID comparison, still 6% below that. By region, in Latin America, is that Central Eastern Europe or something? Asia Pacific, we're still significantly below what people were flying around with by then. But they also have, there's the air distribution system, bookings, air IT solutions, and then they also have hospitality and media distribution and all sorts of stuff, event management and everything else. So they're growing very nicely, coming back to life. I've helped the thing through thick and thin of COVID. And they generate some serious cash flow, up almost 60%, and they're paying down debt pretty aggressively. So I just think it's one of those businesses that's super, super unsexy. It sits in the background. And as we normalize and flights come back eventually, they're doing pretty well. Now look at their earnings per share. So they are down somewhat from the all-time highs. So they're at these levels. And the share price is right now at these levels. So you can see earnings per share and share price actually match up. pretty much precisely. So the question is then, well, given that they were bigger before, the question is, do you think people will start flying again? Do you think people will get over the COVID hump and start, jetting around again a little bit? My view is yes, but I might be wrong on that. But, we're looking at a relatively attractive price point. Again, we're below all moving averages. And yeah, we've been doing that a lot because COVID and post-COVID was pretty horrible for Amadeus. But I just think it's a really interesting business that just collects teeny tiny amounts of money from everything that's related to travel and airports. And they've done a pretty good job coming out of the deep, dark jungle and recovering here very, very consistently every single month with less debt and better numbers. So I like it. Obviously, come up with your own conclusions. What about this one? Profit health is D? Felix, what are you showing us? It's growing, okay, but cash flow is terrible. There's no value. What? Is this one the cat picked out? No, Winston picked this one out. Also, what is it? What is it? Somebody tell me. It's not LVMH. It's not IDEX. It is not Amadeus. It is SoFi. SoFi is down 14% this month. Why? Because banks are down and people are worried about bank runs, and banks sit on about 400 billion of unrealized losses from higher interest rates, which reduce the value of bonds and just all that sort of stuff. Now, it doesn't affect SoFi because SoFi's customer is way more affluent than everybody else out there. They have basically the young high earners essentially on their books, and they just haven't really got an issue with that. No one's going to do a bank run on SoFi. Well, first of all, there is no bank to run to, no branch to run to. I don't see it. I don't see SoFi as that. I think SoFi is a tech company, in my view, with a banking license. Gross profit margin, and you can start to see why I do like this business. 81%. Yes. That's like a tech stock. It's like better than Microsoft. It's almost like a Visa. I think Visa is 95% or something like that. 1.8 billion revenue, no profit as yet, but you can see it's almost there. It's coming. You see, return on invested capital is almost positive. Long-term earnings growth 43%, cha-ching. So it's a growth stock. That's why the numbers look a little bit less wonderful. But look at this. Last quarter added more than 500,000 new members, clients. Super consistent, actually, right? Insanely consistent how they keep adding year-on-year growth. And that's before the student loan moratorium was over, right? So let's see what those new numbers look like. That'll take a few quarters to pick up, but it'll pick up with interest rates where they sit. Financial service productivity loop, and this is what I love. Look, they're bringing in people into a product like money, and then they get them into the invest product, the relay product, credit cards, and so on. And they just sell multiple products, cross-sell to every single member, as they call them, and that's insane. So lending products are only this one down here. That was the core business, and now they've got basically all of this stuff there on top that we hadn't even envisaged 2 years ago. They are the back end for a ton of banks out there, including Robinhood, for example, and I love that. They're the back end of their own backend, they own the whole tech stack, but they also power loads of competitors, which is brilliant. Super consistent earnings per share growth, revenue just consistently a beat. And this is after the US government snatched away their core business. And they just went, we don't care. We will beat guidance anyway. So really, really insane. Now, this again is a week's chart of SoFi, and you can see it's trading at April 2022 levels. So April 2022 levels, and earnings per share, even though it's still slightly negative, is way above it. It was minus 0.8, now it's minus 0.2, and we're trading at the same price level. Does that make sense? The market in the short term is a funny beast. But yeah, I like it. I think the management is extraordinary. I think extraordinary execution there from them. And this one, well, I'm giving it away, aren't I? I'm giving it away. All right, let's make this one easy. McCormick, indeed, the spice lot. Profit health out of this world for somebody who makes spices. Cash flow pretty decent. Growth health pretty decent. Let's look at the actual business. Well, They have a 40% market share in all prime markets. You use it probably every day, or whoever is in your kitchen does. And you can see it's this last one down here. They've had a horrible month, 17% down. Bunch of downgrades, essentially saying your competitors are not doing as well. We're downgrading you, market slowing down. People might buy less spices because who needs cinnamon when the economy is faltering? That sort of thing. And you would be familiar with some of these. I mean, I'm sure you've probably got some of these in your shelf. I certainly do. Can't really avoid this stuff. And ton of brands. And I'm not going to walk you through all of them, but revenue growth has been tremendous. Dividends been raised 37 consecutive years. And while I'm not a fan of dividends, all cat fur up my nose, it's still a sign of very, very strong, consistent management quality and profitable the last 12 months. Yeah. Let's look at some of the numbers here more. Gross profit margin, 36%. So yeah, it doesn't tick my 60% box, but that's because they actually put product into packaging and then they send it out on the shelf and they do all that stuff. That's just going to cost more money. Return on invested capital at 8%. For me, that's kind of borderline, but I like that it's a really different business. It's not what I usually go for. It's just a different business and it's just been growing very, very consistently for a really, really long period of time. It's just one of those brands. So if you look at their Q3 sales just out, after this came out, the stock price tanked massively. They managed to increase prices. So they essentially sold less, but they increased prices, and that's what brought them overall higher revenue. And what does that say to you? That says pricing power. And like so many companies like Pepsi and so on, who raised their prices 17% this year, and all you sugar junkies out there just thought, well, I need my sugar, and therefore kept buying. And it's a sign of good brands or very addictive, horrible products. But, I'm an investor, not a consumer. So this is why the stock's down. This is just out yesterday. Jeffrey slashed the price target to 70 from 87. Bernstein cut it to 84, Bank of America to 86, and median is now 78. Bernstein noted that it was a mixed bag, except for China. The performance seems robust, positioning McCormick well for 2024. Better underlying business performance offset by a weaker than expected recovery in China and greater incentive compensation. I actually quite like the incentive compensation. That's what you want to be doing. You want your company staff to be incentivized. And Bank of America said somewhat expected weakness in China, reiterates buy rating, and says in line with 5-year historical variations, peers have seen multiple compression over the past few months. So they're basically just like doing the sheep thing that analysts usually do. If you look at the stock charts, trading at 65, and it's as we speak. So it's trading at Feb 2020 levels or COVID levels or pre-COVID levels, depending on where you want to get to. And yeah, earnings are definitely, this is a bit close, isn't it? Earnings are definitely down a little bit to pre-COVID levels here, or just sort of COVID levels. So you might say the reaction was reasonable. Maybe it should have come down. But given their history of delivering and their ability to raise prices, and that I think they are quite well set up for 2024, and we've got the slow China growth and stuff now out of the bag. So a lot of the bad news is out there. I quite like it. So we're trading essentially at 2018 valuations as we speak. So, it's just something a bit different. And I think this basically belongs, or variation thereof, on every fridge in the world. It should be the first thing you give to your children when they say, hello, daddy. You go, here we go, is the psychology of the market cycle. Where are we? Nobody ever really knows. But essentially, what people do is they buy when they're optimistic, when they're thrilled, and they're euphoric. This is when retail buys. And when does retail, that's you and me, when do we sell? We sell down here in panic, and the blue line is the stock market. So we're basically saying, dear Mr. JP Morgan, take all my money that I worked so hard for. I'm just going to put it in the incinerator. That's called the stock market. So you want to do the opposite. Now, I don't think we're at panic. I don't think we're even down here. I sort of think we're somewhere up here, complacency. Some people are feeling a little bit anxious, but I kind of think we're up there. So I'd be a little cautious with stock purchases. That's just me. I'd maybe slow it down, or if you just have this 20-year horizon and you do it every month or every Monday or something, okay, keep going. But I just think there is a possibility we might go a little bit lower. But you might think, Felix, I'm not very good at timing the market. That's completely fine. Nobody ever is, in which case you just keep going. But then the important thing is to keep going when you're panicking, when you're freaked out and you're depressed and all of that. When the headlines are like worst day ever, that's when you got to keep going. Got to keep buying in those moments. I just think at the moment, for me, it feels like way up here. That's why I put in the video the other day saying I'm just buying real estate and stuff like that at the moment. And I'm trading, of course. For me, that's always the other thing I can do is, I can just trade and we make really nice returns with trading and it's fun. I enjoy it. It takes me 3-4 hours a week. I love teaching it. Probably the most satisfying thing I've ever done is build this community of thousands of you who are learning how to do it and who are making money, and it's just absolutely staggeringly wonderful. So come and learn with me. Go to felixfranzl.org/webinar, sign up, learn exactly what I do, how I do it. I give it away so you can understand the process and you can get an eye-opener to this strange world of Wall Street and potentially make some money. I thank you for watching. If you enjoyed this video, smash the you know what and share it. Honestly, that's the greatest gift you can give me is if you shared this. It means the world to me, and the algorithm will give you a big, wet, slobbering kiss for it. Thanks for watching. Thanks for tuning in.